Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's September 27, 2019. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week. Today we are joined by the founder of WTF Asset Management, Shalin, where he walks us through his quantitative macro models and what they're saying today. In Kuppy's Corner, we talk uranium. And for our WTF segment, we ask Lindsey Graham, how's his burger?
And in this week's trading history, we're going to go back to 1981 when the peak of interest rates, and then we're going to do our top 5 things to watch next week. So, Lena, jump on here. Who's our beer sponsor this week for the show?
So for this week, our sponsor is Lawson's Finest Liquids Super Session number 7 IPA.
Okay. Nice.
So
That's the only description we get from you?
no, there's more.
All right.
Super Session number 7 is designed to be a light and refreshing beer with low alcohol. Oh, low alcohol. Yet the full hop character of a session IPA. Each beer in our Super Session series is brewed with the same malt base and specialty malts, but features a different single hop variety. Super Session number 7 is brewed with copious amounts of Idaho 7 hops and has tasting notes of apricot, orange, and black tea.
There you go. It's well, you know what? It's interesting. What do you what do you think, Kev?
Yeah, interesting is a good word.
All right, let's go on with the show. Kev, give the disclaimer.
Okay, clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decision regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include mountain plague, beer tumor, and or shivering anxiety. Please visit Dr. Kenneth Noisewater if any of these conditions persist.
All right, let's move on.
Joining us now is Shalin, founder of WTF Asset Management. Shalin is actually a quantitative macro portfolio manager they approaches markets in a little bit of different way. So we're interested to see how he does and what his models are telling him right now. Welcome to the show.
Thanks, guys. Thanks for having me.
So when you were kind of chatting with us and explaining what you do, I realized that you take a much different approach than most portfolio managers. And why don't you tell us a little bit about it?
Sure. Our strategy really emanates from kind of my 22 years as a professional investor in the alternative investment business. So I had an opportunity for the first half of that career to really work with a lot of external managers, hedge fund managers. I was early in the business. And I would invest with them. And I learned about their styles, about their biases. And the second half of my career was really more on the real money side, where I managed a substantial family office. I actually helped build out that program from scratch. And I did a lot of private investing and multi-asset class investing. And what I began to find as this cycle progressed was that this need to be tactical was going to be a necessary feature of portfolio management in the future. Because if you think about markets today, and you're kind of seeing it actually happen in real time, a lot of the theories that we had, but we saw a lot of overvaluation, frankly, a bubble in private assets, particularly in venture capital. And we saw very high valuations in across the board in general for even public assets. So if you think about that, what it means is that on a buy and hold basis for kind of in a family office or an endowment model portfolio, the returns are probably going to be very low going forward. But you could definitely have very large risk on, risk off moments across a number of different asset classes. So if you could do a better job in terms of trading these assets, that would be an important, something that'd be very important and very valuable for investors from not only a performance standpoint, but even a transparency standpoint, if you could give them that transparency.
Right. So are you going and putting these into models that you're monitoring on a daily basis and moving tactically as kind of markets become cheaper or expensive relative to one another?
That's exactly what we're trying to do. So it really just started off like any other quant model with one thing. We would trade S&P, and then if we didn't like it, we would go into bonds, and it was very, very simple. And that was kind of model 1.0. And then we began to realize that, well, if we could layer and add more features to this, and perhaps we would trade emerging markets, and now we could split that exposure in some sort of ratio between S&P and emerging markets. And then we said, oh, well, maybe we could trade Europe. And what we realized, though, was there was a commonality that drives a number of different asset classes, which I'm happy to go into. And so it became a more of a data game. And that was the beauty of the world that we live in today, was the amount of data that's been made available to allow a macro trader like myself to hypothesize what's driving the world. And you see a lot of those, hypotheses, of course, on Twitter. You see a lot of different charts. But the question is, do they have efficacy? Are they long lasting? Are these long lasting trends that, would have done well 5 or 10 years ago, or do they even make sense? And that's what we try to discern.
And it sounds a little bit like you set up the question, but did you find the holy grail, the one indicator that is the most important indicator in terms of allocating to these different asset classes?
Well, one of the things that I realized is that the more nuance you can get, the more precise your portfolio will be, and the more optimal your portfolio can be. And so, we do think that there are some really good indicators out there. We like, for instance, the ratio of copper to gold. That's something that's thrown out a lot, of course. But how you use those indicators and where you use them and what asset classes is extremely important, because with any model, this can be garbage in, garbage out, right? So the more precision you can get, the more of an optimal portfolio you can have for the given environment and regime that you're in. And that's really the holy grail.
So why don't you give us an example of how you use like the ratio of copper to gold to make asset allocations within your portfolio?
Sure. So, have to be obviously very careful, because we are a hedge fund talking about performance, but we did pretty well in the fourth quarter of last year. Okay. And that was a very tough quarter. And as you recall, bond yields were rising. There was tremendous, bearish sentiment on fixed income in general. And we began to write, not only on social media, but to our clients as well, that we were beginning to see an inflection in kind of the asymmetry of owning fixed income versus risk. We'll call it equities, just generically. And if you look at the ratio of copper to gold, you'll see that it did break down, in 2018. Hence, kind of taking out a pillar of the bearish bond argument. Doesn't mean that yields can't go up, but it means that if you were going to put a bet on, you'd probably want to weight that bet a little bit lower, right? Because one of the factors that you'd probably want to see in a rising yield environment has disappeared. But moreover, and I'll just talk about another factor that we would use to intersect that, we began to see financial conditions worsen. So we'll just approximate that with credit spreads, right? We began to see credit spreads begin to widen. Well, if you look at historically, there have been no environments where, bond yields rose substantially in an environment now where you had those two factors in your favor, right? And so therefore, if you're bearish bonds, you might want to reduce that exposure even more, just from a probability standpoint, that your bet might not have as much asymmetry. But then, okay, if you add like another factor like trend's a good factor because the trend is your friend. That also began to inflect around about November, December of last year. So now you've got three things, right, that are not in your favor. So anyway, you guys are getting an understanding, but that's kind of the process that we use to determine how much risk we want to take in a given asset class. It's a very precise probabilistic, kind of form of portfolio management. And then we do that over and over again across different asset classes. And then we create an ensemble. Okay, we just kind of, it just kind of filters into a total portfolio. And so that's why where that can be very valuable is during inflection points in markets, where the market might be completely one-sided on a trade, but you start getting variant perception in the underlying data. And that's what we're particularly good at, and that's our specialty.
Okay, so let's talk about the current environment. What are you seeing, and what are your models saying now?
So there's all caveats. We do run a tactical model, and I have personal discretionary views. And the discretionary views, the things that I talk about, should manifest in the models. That's kind of our approach, is that the models have to be a realistic interpretation of how we look at the world. That being said, I'm a human being, and I can be wrong. And that's why I'm a model-driven investor instead, because I'm wrong a lot, actually. You have many years of mistakes, as do I, Kevin.
Yeah, that's right. So you're already way ahead of most of Twitter by admitting it, though. Most of FinTwit, they get 100% of their trades right.
That's true. It's way different when you have an audited track record.
That's true. Yeah. Actually, you don't realize, but Raul and I were going to start the club of FinTwitters that actually have had mistakes. Because it's a very
it's going to be a lonely two of you that is going to be on there.
That's right, because everybody else is 100 for 100. Anyways, we interrupted. Let's let Shalin talk. Let's go.
So this is a chart that's been brought up by some other people, and it's a chart that we like a lot as well. But what I wanted to do was probably look at it in a slightly different way than I think that's been shown in a couple of charts that I presented. I tried to select a few charts in our library that were maybe a little bit different. So what I've done here is...
Sorry, 1 second. Can I interrupt for 1 second? For those that are listening, we're looking at the global PMI chart. This is basically the PMI, the manufacturing PMI of the global economy since 1998.
And I will add to that even further. Sorry, is that if you're listening to the podcast, make sure you register for the email, because we're going to attach this chart deck in the email, right? So people can view it even if you're listening to the podcast. Sorry, go on. Well, tell us about this chart.
So what it is actually is exactly what you just said, except what I've done instead of showing the actual kind of spot PMI is I've just done a 12-month moving average. Okay, and the reason I've done that was to smooth out, kind of the noise that might come with any individual print. And also, as you know, if you have a 12-month moving average, you can see visually how smooth the trends are, which is why PMIs are really interesting, is because of the smoothness, right? So once you're in a trend, you can kind of get an understanding of which direction the global economy is going. And so in this case, what we're showing, and it's very clear and probably not news to anybody, is that the global economy has been in deceleration. But what I've done is that, you've been in decelerations, we've been in decelerations in the past. That's not a new thing. But what we have found, though, is that when we're below certain thresholds, the risks of various asset classes and various styles of investing increase exponentially. Right, and so
how do you position yourself on this? Like, when you're structuring your portfolio, how do you defensively position yourself when you see information like this? How does that change your asset composition?
This alone would not be sufficient. So that's probably where I differ from some of the other macro traders, because they'll just push this out, right, and say, oh, look, it's 2012 and the economy is declining, right? Or it's even 2013, frankly, and the economy looks very weak. And yet, if you look at risky asset prices, they did very well during that environment, right? So we have to be very cognizant of not only the direction of the economy, but sort of the risk reward in risk itself. And we just tend to fall into, just given the nature of our model, we do tend to fall into the camp where if something's cheap, I don't care what's going on in the macro economy. And so we actually inflect our style to become a little bit more of a bottom-up investor as opposed to a macro investor. So my point is sometimes macro works very, very well, particularly at large inflection points. And sometimes it can be very tricky, like in a 2013 or a 2015, when assets aren't particularly expensive. And here we go. That's exactly right. So if you look at previous environments where PMIs were declining, in this blue line, what I've done is maybe a cyclical versus defensive chart. So all this chart is basically showing is the performance of a basket of cyclicals, okay, divided by the performance of a basket of defensives. And
Right.
I've ranked percentile, just in a percentile rank, right? So cyclicals have been doing really, really well for an extended period of time against defensives. You might be at the higher end of the range, and that's what happened in 2017. And likewise, let's go to like 2016. If it's been underperforming for a while, you'll see that it's going to be very low. And what you find is that this actually it does correlate, and it should correlate with the ISM manufacturing, which is kind of like the PMI index.
Right.
Okay.
Right.
And so what happens where the variant perception comes is when there's a spread, when there's a huge difference between the two. And that is kind of in the position that we're in right now, as you can see. And so what that means is that whereas in the past, the global PMIs were not necessarily as effective as an indicator, they should be today, actually, because what you find is what we find is that a weak economy is not sufficient, and expensive valuations are not, sufficient. But a weak economy with expensive valuations, that's a really toxic cocktail, and that's kind of the punchline.
Right.
Okay, I'm going to jump in here now. I've seen on Twitter that you're a 0%er, are you not? A little bit of a bond bull?
In the long term, yes.
Yeah. So why don't you walk me through why you think that? I'm always an open mind. I'm ready to hear the reason I'm wrong, and walk me through your bond bull argument.
Or the reason that I'm right. Which one is it?
Why don't you walk us through your bond bull argument? I'd love to hear it. I'm curious why you think bonds are, U.S. bonds are going to go to 0%. 0%, just for those who knows.
Okay, so this is really there's a couple of more technical reasons, and then there's a more existential reason, which people can argue, all day long, but it really goes to the heart of the argument. And so in the short term, I think there's this next page should have a chart. There we go. The next one. Yeah. If you look at the spread, right? So it's a very simple argument, but if you look at the spread between European bond yields and U.S. bond yields, you see that by and large they've tracked each other pretty well over the years, right? And we've got 20 plus years worth of data here. What you have now, or at least what you had at the beginning of the year, was the largest spread over the last 20 plus years, and that spread, of course, has begun to converge in recent months. Part of the reason is that despite the fact that European bond yields have actually fallen, they're so bloody low that you're hitting what's effectively a zero bound. Who knows? The ECB might go to -5 for all we know. In this topsy-turvy world, but you have to believe that the second derivative of changes is going to slow down, right? But with the U.S., of course, there's still plenty of landscape for conversions, and so therefore, just on that kind of simple spread argument, that's one reason to be bullish. Now, the more existential issue is how we define money, and I think that's where I just tend to fall into the bucket of people who believe that credit is money. Okay, so any form of credit creation in the here and now is an inflationary sort of trend, right? So if I take out my credit card right now, I don't actually have any income, but the credit card company is giving me $10,000, and I go spend it. I've pushed forward my consumption today for something that I won't be able to do on a consistent basis tomorrow, and that in and of itself is disinflationary or deflationary. So the more you push forward credit and push forward returns in a credit-based economy, the more deflationary that is, right? Because you've pushed forward spending, and that is ultimately bond yields have to will fall in that sort of environment because money velocity will fall. So that's kind of the fundamental issue with the economy right now, is simply that we've pushed forward so much demand vis-a-vis the credit, this kind of credit-based economy and very low interest rates that are perpetuated by central banks, that the outcome of that, it will ultimately be inflationary. I don't disagree with you, but people don't realize how the money multiplier and the credit multiplier works, and how, with respect to inflation and the other things that it affects. So that's
Okay, so
kind of the short answer.
right. So,
A
so
very
that's a great answer.
complicated
I'm sure Patrick would be all over that. And then you weren't Raoul Paul bond bullish though, so you didn't tell us it was going negative. So you aren't the most bullish guy we've ever had on the air here. So the one thing I'll just ask for one last question. Give us kind of your take about where S&P and like U.S. stocks are headed in the next, maybe let's say 6 months to a year. What's your thoughts?
It's extremely difficult. The whole rally this year has been a function of multiple expansion. That's a really tough environment to play because it's not really fundamentally driven. It's very difficult for me. Now, I've given this whole spiel about where bond deals are ultimately going to go, but I will say that the level of bullishness in bonds right now, and the overbought nature of bonds, and how CTAs, for instance, are positioned, probably means in the short term that yields are contained. Okay, and without it's been our estimation that the bond rally has been very, very integral to the stock rally, and without bond deals kind of having that bid in the interim, we think that could be pretty negative for stocks. So we're pretty bearish. I'm not going to give you the perma bear sort of target, but we do think that part of this multiple expansion unwind is going to be rectified probably in the next 6 to 9 months.
Okay, well there you go. Oh, thank you so much for joining us. Why don't you tell people about where they can find more of your reading and what you do, and check you out on Twitter, and why don't you give people the goods?
Yeah, so Twitter handle is BodhiTreeCIO, BODHITREECIO, and our website is B as in boy, TAM.co. We've written a lot of research papers, which we share for anybody who's interested. One of those research papers, if you guys remember, was last December. We basically predicted, using some of the things that I mentioned to you, why bond yields will go substantially lower. And we actually predicted a global recession to hit by the third quarter of 2019, which, I'm not sure about the U.S., but I think that the rest of the world could very well be in a recession right now.
Okay. Well, thank you very much for joining us.
Thank you.
Also, if you want to hear more from Shalin, just make sure you join us for the After Hours segment at the end of the show. So joining us now is Harris Kupperman, who is better known to our listeners, Kuppy. Now, Kuppy's been publishing the blog Adventures in Capitalism now for many years, but we're proud to have him as a regular on the Market Huddle now in what we call Kuppy's Corner, which is the last week of every month. We're going to bring Kuppy on to pick his mind as to what's going on. So how you doing, Kuppy?
I'm doing great. Thanks for having me on the first episode of Kuppy's Corner.
Fantastic. And how you're out in New York? What are you doing out there?
Well, I was at the Brookfield Analyst Day, but I promised to come on. So I stepped outside. I'm in a courtyard. There's some crying babies. There's helicopters. There's a ferry honking at me. If you hear some background noise, I apologize, but there's nowhere quiet in Manhattan.
Oh, no problem. All right. So listen, what I really was inspired to ask you about and get you pick your brain is talk uranium, because you wrote a great article on your Adventures in Capitalism blog on it, and I really wanted to share that with all of our listeners. So, what struck me right away when I was reading it was when you were talking about the last bull and bear market cycle in uranium. And we had, before I had a chat with with Rick Rule, and he shared with us a truism, which was that bull markets become the author of a bear market, and bear markets are the author of a bull market. And no better example of that is in the commodity markets, and particularly uranium. Now, you were an early investor into uranium back, was it like 2003? And you went
Something
through
like
that whole bull market. Why don't you take us through what happened back then?
So uranium back in 2003 was one of these once-in-a-lifetime sort of things. You see, there had been massive deficits for years and years and years after a 3 Mile Island accident. So there's a structural deficit. You have a situation where you have the megatons to megawatts program, where we were taking old Soviet weaponized uranium and turning it into supply for power plants, which basically took the price of uranium below the cost to produce it and bankrupted everyone. So uranium was just structurally way below the cost of producing. I think it was like $12, $13 a pound back then. And you had this looking forward that the program was going to end. And then what happened is the few producing mines started having problems. Cigar Lake flooded. MacArthur River had another issue. And suddenly all the utilities said, hey, wait a second, we're worried about our supply situation. And they all went into the open market and bought uranium, which probably would have worked out just fine. The difference is that you had guys like me who were hedge fund guys who went into the market and said, these utility guys are kind of slow and dumb. Let's buy all the uranium and sell it back to them $100 higher. And that's basically what happened. And so these utilities start panicking because every time uranium comes on the market, some hedge fund just takes it. And, a power plant is kind of a giant paperweight if you don't have uranium. So these guys start looking, they're saying, oh, wow, like we have a problem here. I'll pay any price for uranium. And I'm worried, normally we run with, 2 to 4 year supply, but I'm worried how it's going to work out. Let's just lock in 10-year supply. And yeah, the cost of uranium is a few percent of the cost of our power plant. So it doesn't really matter what price we pay, really. And they just start locking in the supply at 100, 110, 120. And I mean, it just ran the price. It was some crazy thing where once it started going, you just knew it was going to keep going because these utility buyers were in a panic. And, I didn't have any uranium participation back then. I was playing this through junior miners, which, just so everyone knows, is probably the worst possible way you can invest in the world. Every one of these management teams were criminals, but it didn't matter. I think there was like 11 of these when I started, or 12 or something, and I just bought equal parts of each. And it didn't really matter what you bought. They all went up, and they just kept going up. And, I mean, I was coming into these at 10, 20 million market cap. And in a lot of cases, I owned 9 in each of these companies. And for about 3 years of my life, there was nothing I needed to do. I kind of woke up at noon, sold a bit of my position, went back to bed because literally nothing else in my portfolio mattered. I mean, my uranium book, a lot of these were like 30 and 50 baggers. And, my hedge fund at the time, when my uranium position got into the 30s, you'd cut it back. So every week, uranium stocks would go up 20, 30%. So I would just put in some sell orders to go back to bed because the rest of my book didn't even matter, really. And it was a great thing.
Oh, absolutely. I mean, I think from 2002 to 2007, Cameco went up like 2,000%, and that's the big boy, right? Like, I mean, these juniors would have just been exponentially even more leveraged to the upside. But then we've gone through quite a bit of a bear market since then, haven't we?
Oh yeah, I mean, in the end, the world's demand for uranium is somewhat fixed, and so once these utilities had locked in their demand needs, there really wasn't any more need for uranium. And you had issues. You had Fukushima. You had just this oversupply. And this oversupply has weighed on the market, and it's been adding and adding. You also have issues where the price of SWU went down, so you had underfeeding, which added excess supply to the market. You've just had supply come on. I mean, when you think about the last cycle, the odd thing about the last cycle is that the whole time you actually had excess supply. The supply-demand imbalance, and people, I think, missed this, you probably had excess supply, more or less, because you had a governmental supply, you had the weapons program supply. It was just really utilities freaking out and buying inventory.
Right.
And what's different this time is that you actually have a supply-demand deficit now. You actually have a situation where demand is 190-ish, going on 200 the next year or two, and supply from primary production is like 120, 130-ish. And then there's some secondary supply from underfeeding and some other stuff. But you have like a 30-ish, maybe even 40-ish deficit. And I mean, looking forward a year or two. And that deficit keeps building each year. Plus, you have a situation where a lot of utilities ran down their inventory and they need to add inventory, which just puts excess demand on a constricted supply number. And so, you have the makings of a very good bull market.
Right. And so now one of the things you discussed was that at the bottom of a market, you want to see true capitulation in producers. And one thing I can, at least what I've heard, and you can confirm if that's the case, but there really is almost no new exploration whatsoever going in the uranium space. And even then, a lot of the producers are cutting back. I mean, is this enough capitulation for you in your mind?
Well, as soon as you go into a deficit situation, you've seen some capitulation. And what we've had is quite a lot of capitulation. There's at least a dozen major mines that have shut themselves. You have a bunch of other mines that are running at well below where they should be. These are the ISL, ISR sort of mines in like Utah, New Mexico. You just have had a lot of supply come off the market. And,
Right.
it's very different from, say, natural gas, where I clearly got it wrong. And I was writing about this. Like, we never saw the bankruptcies in the gas producers. And so you keep having the supply come on. And uranium's different, that you had the bankruptcies and you've had the Langer Heinrichs that shut down. And, it's just, you had, MacArthur River. You had all these other large mines that just are shut down, care and maintenance. And that's
So yeah, that's
all
right.
up.
Because MacArthur's shut down, and Cameco is buying uranium at spot, isn't it? Like it's
Well,
actually contributing to soaking that up, isn't it?
so, I mean, this is, I think, why the trade is timely now, okay? So you could have a supply-demand mismatch, and it can go on for years because you'll work down above ground inventories, and, you have users that say, nah, every time I wait 6 months to buy more, it's cheaper. Why do I have to buy more? Why do I have to finance this stuff on inventory? So inventories get worked down, and eventually, you have the turn. And in the case here, Cameco, who's the second largest producer, was looking at the situation, and they're saying to themselves, why the hell are we producing this stuff at 30, 40, 50, whatever their all-in cost is? And all-in cost is very different than the mine gate cost they quote you. It doesn't include corporate SGA and financing costs and depreciation and all this other stuff. So whatever their actual all-in cost, they're saying, let's say the cost is 50. Okay, why are we producing this stuff at 50 and selling it into these term contracts we have, when we could just go into the spot market and buy it at 25? And, it's half as expensive.
Right.
And plus it cleans up a lot of that excess supply. And so that's what Cameco's doing. They've been very vocal that they intend to go into the market in Q4 and try to manipulate the market higher. And when the number two guy says we're going to manipulate the market higher because we stopped producing and we're going to absorb a bunch of excess supply, and the number one producer, which is Kazatomprom, says that we're not going to be adding any incremental supply, setting it up so that Cameco can clean up the mess. It's bullish. Will they actually get the price up in Q4? I don't know. But Cameco is going to probably do the same damn thing in Q1 and then Q2. Eventually, they will have absorbed all the supply,
Yeah.
and they will push the price up. I mean, look, if you were a uranium guy that was trying to sell uranium, if you're a mining company, yes, you have to sell uranium to make your payroll. But if you're a guy who has inventory warehouses of this stuff and you don't really need to sell it this year because your financing cost is negligible, why would you sell it today when you can wait 6 months and maybe get 40? If you
Right.
believe Cameco, why would you sell your if you're a Japanese utility with some excess uranium that you're trying to dump, why dump it today? So I think you're going to have a
Yeah.
situation where the offers kind of melt away a bit, and Cameco will push the price up, and that's why I own a hell of a lot of UPC.
Yeah, we'll talk about that in a second. I really wanted, before we get to UPC, I wanted to quickly just touch on the growing demand. So we went from back like in 2011, where Germany and Japan are shutting down reactors, and the demand side was driving that, to now a wave of new reactors coming up in Asia and India. So you really think that the actual demand will start to appear in the coming years? Is that a good way of summarizing it?
Yeah, I mean, that's a great way to summarize it. Look, I don't like to generalize when you're talking in finance, but this is an easy situation for generalizing. You had a lot of power plants that were supposed to shut down over the last few years and the next 10 years. And almost every month we get another headline that another power plant is going to be extended for 2 years, 4 years. And this is not just Europe, this is the United States, it's everywhere. In the end, there is no really good substitute for baseload power that's carbon neutral. eventually they will, run the solar panels, the wind farms, and then put it into a battery. But we're not there yet. So your choices are coal or nat gas or diesel or uranium. And these power plants are going to be extended for a couple more years. And every year a power plant's operating is 500,000 more pounds that gets absorbed. So that's on the existing plants. There's a whole ton of plants being built in India and China. And those plants need uranium. First thing, you have to stockpile a few years of uranium before they turn the plant on. But then every year incrementally going forward, they need more uranium. So you actually have growing demand. And if you look at the models from, say, 2 years ago, people saw demand actually shrinking going forward. So it's very, very different in terms of what the model looks like. And then you play it forward 5 or 10 years and you see, substantial amounts of incremental uranium needed versus what people thought just 2 years ago.
Right. Right. So what was interesting in your blog, you talked about UPC, which is the Uranium Participation Corporation. It's a Canadian entity. It trades under the symbol U here on the TSX in Canada, and something I'm quite familiar with as a Canadian. But for a lot of international people, they're not aware of that this unit even exists. But you think that this is a great way of playing this uranium. So why don't you talk about why you think this is the best way to play it?
All right. Well, let me start off by saying that if I had never played in junior mining stocks, I'd be a much wealthier guy today. As I made in junior uranium stocks. I ended up losing a lot of that money in gold stocks. And I think that mining is a very difficult place to invest. It's capital intensive. You have permitting risk. You have geology risk. There are specialists like Rick Rule that seem to get it right, like over and over and over again. But I'm not one of those guys. So what I'm playing is the price of uranium going from 25 today to some higher number. And I don't know what that magic higher number is. I don't know if the Kazakhs get it to 40 and they say, okay, we're going to increase production again and keep it at 40 so that, the Western guys never bring their supply online. If I was Kazakhstan, that's probably what I would do. I don't know if it overshoots and it goes to 60 or 70. I just don't have an answer to that. What I know is that everyone who produces this stuff is incentivized to get the price up suddenly, and they all have a bit of collective discipline, and the price is probably going higher. And Uranium Participation owns physical uranium in multiple warehouses. They own some hexafluoride. You got a little tiny bit of cash there. It costs you about 80 bips a year to hold on to it. It trades a few pennies below NAV. And I just think it's the best way to play this because, look, I'm probably early. I know I'm early. If I'm 1 year early and it's costing me 80 bips, well, it's a $4 stock. It's going to cost me about 3 cents. And if I'm 2 years early, I'm at 6 cents. The average daily range is about a nickel or dime. It's just totally irrelevant to the investment if I'm even 5 years early. If you're 5 years early in a junior miner and they have to raise money every 6 months to make payroll, well, there's going to be 10 times as many shares outstanding. You'll have nothing when the turn comes. This just seems like a much better way to play it. And yeah, you don't have that supposed operating leverage, but I've been told by a lot of people over the years that mining gives you operating leverage, and I haven't seen it very often. So I'm going to own this Uranium Participation. It's marginable, which is great. I think it's one of these rare situations when you can take a very, very large position because outside of mark-to-market risk, which is a real risk if you're, monthly liquidity or whatever your fund mandate is, but outside of mark-to-market risk, and maybe uranium goes to 20 before it goes to 50. There's no permanent loss of capital risk outside of fraud. I don't think there's fraud here. So you could just sit on it and wait, and you're pretty much guaranteed that in the next few years you will double your money. And I can't say that about any other asset.
Well, the one thing I like about it is for Canadians anyway, on the Montreal Exchange, they have options on the UPC. And so I'm able to actually even play it with options for even some further leverage, but I know it's not available for everyone. But anyway, thanks for sharing that. But Kuppy, before I let you go, I want to just get an update from you on Sting. Scorpio has been actually doing very well in the last little while. I saw a headline. I just wanted to know whether you thought it was actually relevant or not. But there was that headline about U.S. sanctions being put on to a number of these Chinese shipping companies like Costco Shipping and others with that uranium story. Does that in any way influence Sting? Probably not, right?
Well, it's bullish. Every time that a government messes up existing trade routes, it's bullish because a vessel needs to be repositioned that wasn't scheduled to make a run. So every time someone in the government changes something, it's bullish. And it's definitely bullish for everyone. And even if it doesn't directly impact product tankers, it ends up adding an element of fear to things where large trading houses need excess inventory of vessels just in case, product tankers are the next one to get hit. And so, I mean, I'm super bullish on this. I don't know if you saw, but this week the company acquired 19 vessels, added to their fleet. It's about a 20% increase in the fleet. They overpaid a bit. You don't really want to see that, but that's life. But the insiders also put $15 million more into the company, and Trafigura put $35 million in. And Trafigura sold for shares. And Trafigura tend to be the smart money in this world. And they took shares, not cash, and they put $35 more in at $29 a share, and we're trading below that today. So that's what the smart money thinks, and I think it's good. I mean, I'm super bullish.
So and the story, it's coming to the tail end of this year. That's the for all the scrubbers and stuff like that. Was there a date on that? When was the date again on that?
So there's no set date. Okay, January 1st, you have to start burning low sulfur fuel, and the demand increase for low sulfur fuel is probably November or December, when these vessels need to stock up the ports. So we're expecting charter rates to start increasing end of October and into November. If charter rates don't spike by end of November, I'm wrong. But I think we're going to see a spike, and I think it's going to be very bullish.
So the catalyst is actually coming up pretty soon. So it's keeping an eye on this. Is going to be a lot of fun. Anyway, Kuppy, listen. Oh, sorry.
One last thing I'd add to this. I've been doing this 20 years now, and I can't remember the last time I saw the CEO of a public company spend $500,000 on 3-month call options. And CEO of Scorpio just bought some out of the money call options and spent $500,000 in premium. So what he thinks going to happen in Q4.
Well, you know what? That gets me even excited. All right. Anyway, Kuppy, listen. Thanks for taking the time out of your investor day there, and enjoy the rest of your day out there. And thanks for coming on. And we look forward to another update from you next month.
Sounds great. Thanks for having me on.
All right. Thanks, Kuppy. Cheers.
Cheers.
All right, Kev. It's time.
Yeah. What is it? What time is it, Patrick?
It's time for Tales from the Trading Desk.
I know, and I'm not doing one, and I think you're going to actually step up to the plate and take a swing.
Absolutely. You know, I've been saving this one, so let's see how it goes. But the tale I want to share is from my early days at CIBC with a good buddy of mine that was a friend named Ed. And me and him were like two peas in a pod back in like 99 through 2001. We were both bearish the NASDAQ like crazy and both used the dark arts of technical analysis. Good buddy. And so he's getting married here, Kev. And he's getting married. Lovely wife. And I was happy for him. But the guy was milking the system to say, like, the guy, like a month or two before the wedding, was calling in sick constantly, but I knew it. I didn't like rat him out or anything, but I knew it. But like he's calling in sick to do wedding planning, so he's calling in sick to go and pick like centerpieces or do all this stuff like that. And it, like at the time, I was like, this is pissing me off. It's like, it's a good buddy. It's like, if he calls in sick one more time, I'm gonna have to punk him. I'm gonna have to prank this guy on there. So. Long behold, it's a week before his wedding. It's Friday, and guess who's not sitting at his desk?
Ed.
It's Ed. He's not there, and I'm like, oh, that's it. This is my last chance to prank him. So I'm like, okay, let's get in. So I talk to the supervisor and then get the manager involved and like get their blessing. And send him an email with the whole thing. And so I'm like, I want him to think he's getting fired a week before his wedding.
You're a good friend, Patrick.
A good friend. And so with the blessing of everyone, I basically go and pack up his desk into a box. Nice. And put it onto his chair and put a sticky on one of his monitors, basically saying, go see the manager. And so we all get in there a little early on Monday before he gets in. And he comes strolling into the office, and he kind of like steps to his desk. He's like, "What's this? What's going on?" No one makes eye contact with him. Everyone's trying to keep the straightest face possible, and we all like kind of shrugging our shoulders, right? And so he kind of goes and sees the sticky, and he's like, he goes and he talks to the manager, and she immediately says, "Come with me." And she takes him into the one little private meeting rooms, and sits him down there and says, "We're waiting for somebody," and closes the door behind him. And she lets him stew in there for 10 minutes. Just imagine what's going through his mind. Like, what did I do? What am I going to tell my wife? It's a week before the wedding. Like, just think of the sweats you have, right?
Yeah.
10 minutes later, she walks in there with a printout of the email that I sent her to be a part of the prank. And she just gives him the paper and says, "Can you explain this?" And she walks out of the room. And so he reads it, and he was pissed. He was pissed. He comes out, and I thought he was going to rip me one. And as he's coming out, everyone on the desk just stands up and starts clapping. And luckily saved me. And so, like, he had no choice but to smirk and laugh because he was realizing he's punked. But that's not where the good part of the story is. All right. So let's actually move forward. So I got my little prank in there. Now fast forward a week later, I'm at his wedding.
Okay.
All right. So I'm at his wedding. It's being held at Castelloma. People not familiar with Toronto, it's a great place to have your wedding, and it's in a big library in the mansion there. And I'm just minding my own business, drinking beer, eating dinner. Everything's great. And suddenly, shooting the shit with the rest of the guys that are there, and suddenly. The master of ceremonies is standing beside me, and he says, "Patrick, Ed wants to talk to you. Can you come with me?" I'm like, "All right." I'm a little drunk, so I didn't even think twice about it, right? Like, so
Patrick, you drunk at a wedding? I don't see it.
No, I don't see it.
I
either.
don't see it. I don't see it.
And so I'm walking, following him, and we're about halfway through the little dance floor area, and suddenly he grabs me by the shoulder and turns me toward all the guests. And suddenly something just flashes, like something's going to happen. Like I was completely unaware of anything, and it's like my heart's like stopping. Like I'm starting like, oh my God, what's happening here, right? And I'm like looking around, and there's a goddamn karaoke machine. Right there in front of me on this floor, and you know how they say that revenge is a dish best served cold. Well, it was damn cold at that wedding, and so like I'm like, oh my God, and then but I didn't even have a chance to react, and he turns on the mic and he announces, "Ladies and gentlemen, Patrick's going to start the karaoke tonight by singing Shania Twain's 'Man, I Feel Like a Woman.'"
Did you do it?
So this is the fight or flight moment, right? Like, do I just make a dash for it, or do I? No. Like, little context, okay? I cannot sing. I am actually one of the worst possible singers, and to be honest, I'm terrified of karaoke. Like, this is like petrifying for me. If I was a great singer, that's like, hey, I'll carry this thing. And worst of all, I freaking never, like, I heard the song twice on the radio. Like, it's not like I've downloaded or bought her album back then, and so I don't know any of this. And so I have a choice. I can either bail or I can do it. And I'm like, you know what? He needs his revenge, and so I decide to sing it. And and he's having a hoot while I am destroying this song. But the worst was there were these two little kids, probably like 8 and 10 years old, that came running from the sitting in their area to sit down on the floor, thinking that they were going to be entertained by this show. And the look of horror on their faces right in front of me as they're watching me destroy this song, and they're like, "He doesn't know the words," and they're like, I still to this day have nightmares of these kids that are there, and
it's
the
like
lesson.
Children of the Corn.
Yeah, and lesson learned that karma's a bitch, right?
Yeah, it is.
It's-
Yeah.
Yeah,
Patrick, that's a great story, but I'm calling bullshit on the fact that you didn't know the words to the Shania Twain. I think you had all of her albums and you knew them off by heart.
She's
and
a
that's
great
why you tell us
Canadian
that.
singer,
Yeah.
right? Lena, insert right in here that little chorus part of that song. Like, do that. Just put it in here for fun.
Man, I feel like a woman.
All right, but anyway, that's my
Anyways.
little tale.
I like it. Great story, Patrick. Good story. And for those who don't know, Casa Loma is actually in the X-Men. I don't think you realize that, but
No, I
a lot
didn't.
of times when they're at school, they're at the Casa Loma. So it's actually a famous movie prop as well. And you can just go to watch the X-Men, and you can see Casa Loma in various different kind of iterations there. Anyways, thanks for sharing that with us,
Thanks.
Patrick.
All right. Let's time to move on for this week in trading history. And again, normally I kind of grab this by the reins, but I think that this is one that both of us can contribute quite a bit to. Now, we wanted to talk about September at the tail end of September of 1981, when we saw the 10-year Treasury yields peak out just over 15% back then, right?
Yep, that was
And
the top.
That was the yields top, and that was the big bottom in bonds, and that was the mark that began the beginning of the great bond bull market that still goes on today. And no matter how many people want to already call this bond bull market over, I still think we're in the midst of it, and it's not over yet. Though it is ninth inning, maybe going to the overtime, but it's still on anyway. Yeah, I mean you think it's over, isn't it?
For sure.
Oh my God!
I
All right.
actually think August was a climactic peak. But anyways,
So,
I might be talking my book.
Yeah, so now let's put a little context, because okay, fine, what carnage happened before? So we talked about Volcker in our prior history session when he came in and took over the Fed, but there was a massive spike in yields and interest rates back then, and it caused a lot of bond carnage. To kind of put this in context. For year over year, the prime rate went from 13.5% to 19% in 1 year. You had the discount rate 13 to 14. You had the Fed funds rate go from 13.05 to 17.06. You had 6-month savings certificates paying over 15%. I mean, I think mortgage rates were even close to 20, right?
Right. That was the period, Patrick, when they called bonds certificates of confiscation.
Really, eh?
Oh, yeah. They were, yeah. As bullish as everyone is now, everyone was that bearish back then. It's almost the exact scenario in reverse.
Right.
If you wanted to tell the story, you just kind of flip everything on its tracks, and it's the exact same. Anyways, I'll let you continue. Tell us,
No. It's not meant to continue. I mean, listen, you can talk your book and tell us how bearish you are. But what I did want to share was a second interesting thing about the peak in those like there have been throughout this bond bull market a number of periods where yields had a substantial rise and caused some carnage. I just cherry picked one, which I thought was an interesting example, was this Fortune magazine article that was called "The Bond Massacre of 1994." And back then, I think you looked it up, but the 10-year yield went from, what was it, 5 to 8?
5 to 8, yeah. It was a big move.
5% to 8%. I mean, it's
in
it's
a short period.
very short period, and there was over $1 trillion back then. Now, trillion used to be a lot of money back then, right?
Yeah.
Nowadays, it's a rounding error, but
That's right. It's just a day's QE.
yeah, 1 day's Q. But back then, there was over $1 trillion of bond losses in that period, right? We've seen many of these kind of periods where bonds back up, and it's really interesting to have seen that peak and what interest rates were. And at some point, we're going to see the existing bond market change its stripes, but I just don't think it's yet.
Oh, no way, Patrick. Bonds are going to minus negative yields, and the trends in place. Get it.
-4, right?
Yeah, -4. Listen, that's just the worst case scenario. What if things really go bad? I'll tell you one thing.
Listen, I think okay, go for it.
I'm sorry to step all over you. That's terrible, but I want to say one thing. And this is kind of important to remember. And I touched upon the amount of bearishness that there was in 1981 when bonds peaked.
Yeah.
And that bearishness continued for a long time. And I want to talk about one person in particular. It was Dr. Henry Kaufman, and I believe he was at Salomon Brothers. And they called him Dr. Doom. And Dr. Doom thought he was a great interest rate forecaster. And the reason he was because he was always bearish. And he always thought there was going to be more inflation and that the world was going to, explode in a fiery, incendiary, inflationary ball. And so he was always bearish. And he was
always right up until
1981. But the point is that he was celebrated for the longest time, and then the whole way down in terms of yields up in bond price, he continued to be bearish.
Yeah.
And I contend that we will have the Henry Kaufman of this next turn, and I am hereby nominating you as my number one. It's my number one kind of choice. No, I'm just kidding. But there will be people, and this is an important thing to realize, is that
you mean like people that are bullish Bitcoin right now?
So I think you're going to find that there's going to be a turn in interest rates someday. Yeah. I will be right someday, like you say. It's probably when I've given up on my position.
You will definitely have covered by then.
And I'll tell you the mistake will be to be getting bullish too early and not realizing this trend will flip and will go on for a long time. And I suspect there will be the guys that are celebrated today for being such great bond traders and so smart with their calls will stick and be long and bullish the whole way down. And it's important to realize that you should pick guys that are flexible, that are willing to change. And
so why should they listen to you? Because you're not
exactly.
Flexible.
You're absolutely right. Absolutely right. You shouldn't listen to me. I've been bearish the whole way, but I'm just saying that there will be the next Henry Kaufman of this next bear market.
Inflation is coming.
It is coming, and you know what? You can laugh all you want.
One day you'll be right. Just as long as you keep repeating it over and over again long enough. One day you're gonna be like 70 years old, sitting on your porch, well retired, and like, see, I told you.
Okay,
I told you inflation was gonna come.
What I find the most amusing is that why anybody that has to own a bond for a long period would actually want rates to go down over the short run is beyond me. If you actually believe that there's no inflation, then you should want lower prices so that you can buy it and hold them. And it's really just the people playing hot potato and passing this from one on to another, and the central banks doing more and more that are cheering this bond bull market. Yeah. And I contend that there's more risk in the bond market than any other market out there. Anyways, that's what you've heard me rant. Yeah, I don't need another rant. This is this week in history.
Now, and you know how many people are gonna give you Twitter shame now? You just opened yourself up.
Well, that's not true because bonds have been going down recently. So the reality is I don't get quite the same shame that I used to. Anyways, thanks for sharing that with us, Pat.
All right, so Kev, time for the WTF clip of the week. So what do you have in store for us?
Well, Senator Lindsey Graham was at it. And I don't usually do political ones. And just so everybody realizes, I make fun of all politicians. I don't choose one particular party over another. If somebody walks into something that I think is a great mashup, I use it regardless of.
You have no mercy on anyone. Nobody's safe. And why haven't I made a WTF clip yet? I have to.
You
make
should do it. You should do one. You're welcome to do one.
No. With
anytime.
me, no. I want to be the victim.
Oh.
We're gonna find a clip of me saying something really. Actually, no. I did make it into your little bear mashup. Remember?
I can't remember. Anyways, let's talk about this week's.
All right.
Lindsey Graham, famous senator, I believe, Republican side. He was busy out, like kind of coming to Trump's rescue. He said something that was reminiscent of my days on the trading floor. And I'll just tell you a little something. There was a couple of movies that were really important when if you were kind of a 20-odd-year-old on a trading floor in the 1990s. One of them was Caddyshack. You had to know all the words for Caddyshack. The other one was Dumb and Dumber.
I agree.
And Dumb and Dumber was a classic movie, and one of our favorite ones was How's Your Burger? Anyways, let's play the tape, and you can see what I mean.
The president was between a rock and a hard place. I think he did the right thing.
Feeling better, girls? Yes, much better. Thank you for asking.
You know, I'll make my own opinions up, and I have.
So what are you going to ask me? Vacation? Why don't you eat up and we'll tell you.
And I'm really clear about this. This phone call is a nothing burger in terms of a quid pro quo.
How's your burger?
The President of the United States did not remotely suggest to the Ukraine, if you don't do my political bidding against the Bidens, I'm going to cut your money off.
Are you okay, man? It was just a goof.
He talked to me last night about South Korea needs to pay more. Maybe we should withhold money from South Korea. And I said, they probably should pay more, but...
Ow, my ulcer. Quick. My pills.
Maybe somebody should call an ambulance.
Look, you get the pills. Don't worry, I know CPR.
This is a lot easier if you just lay back. Here.
Son of a bitch.
Check, please.
So I just want you to say, whenever someone got stuffed on a really bad trade, we would always say, whoever it was we ran over, let's just imagine Moose Pasture Pension Fund. We go, Moose Pasture Pension Fund, how's their burger? And we'd always have a laugh, right? And that was always our joke on the desk. So it was very fitting when I saw Lindsey Graham talk about it being a nothing burger. And I thought that this was a perfect mashup.
Oh, you did a great job. That was really funny. It's it's funny because it's such a classic movie and classic scene.
Do you know there's a great documentary about how that almost didn't get made, and how nobody wanted it, and all the studios basically read it and said, this is the stupidest thing I've ever read, and they couldn't get anyone to do it, and it was like 5 years. Anyways, I should pull it up and include it in the show links because it's a great documentary on it, and it's a great movie. Obviously, it's dumb as anything, but it's just one of those things that's terrific. Actually, my favorite scene is the end. When the Hawaiian Tropic bus comes by, and they ask him they ask him to be a massage boy or something, and he's like, and then he says, and he says no, but here you could go down the street and find some. Anyways, terrific movie, love it. Jim Carrey, a Canadian, it's good to see. Anyways, that's it. I have nothing more to add.
Okay, so Kev, let's move on to the top 5 things to watch next week. But before we do, let's jump to a quick review as to what happened last week and what we thought was important to watch. So obviously we were talking about those PMIs, and boy, did they shit to bed. Particularly the German manufacturing PMI, like 41 handle.
Yeah, it's ugly. I thought
every month, all I hear from you is that that's the bottom. It's not going to get any worse. The rate of change is going to, and every month it never shocks that Europe can get worse.
Well, it never. You know what's the most amazing thing about Europe? They keep doing this, but they keep thinking that somehow more negative rates are going to solve their problem. Okay, you know what? Minus 50 wasn't going to work, but I'm sure minus 100 will work. You know that company that was thinking about taking out money, they didn't want it at minus 50, but they sure will want it at minus 100. It's absolutely bonkers that they continue to try fixing all their problems with more monetary stimulus and haven't realized that the issue is the fiscal side. Now, having said that, Patrick, I want to say one thing, and I realize this is early. It is early, but there is a lot more chatter from people in Germany, and I realize it's not the people that are making policy, but it's people who used to make policy or that are in charge of companies that are chatting about the fact that the need for the fiscal. And, you know, our good buddy Chase from Pinecone Macro pointed out, I think there was 3 different articles written the other day on one day in particular where they very prominent Germans were coming out and saying, nope, the time for more monetary stimulus is behind us. It's time to do fiscal. So you can say what you want, but I think the fiscal is coming.
No. Listen, listen. You've made the case. I actually don't disagree with you. I'm not going to push back on that. The thing, there are cycles, and inevitably, it's going to lead. Either A, they're going to let shit completely fall apart, and then they have no choice but to inject massive fiscal in there to stimulate it anyway, or 2, they're going to do it preemptively, but it's coming. It's just about when do they start it and from what base they begin, right? And so we'll see. But right now, no sign of improvement. Anyway, let's move on to U.S. GDP because we don't need to hear you ranting about Europe anymore. What I find stunning about the U.S. GDP coming, I think it was like 2% or something, but each month it seems unchanged. It's almost as consistent as Chinese GDP forecasts. Just it comes in perfectly every single month. Like
but
clockwork.
It's backward. But Patrick, it's actually the result.
But it's consistent though. I forget backwards. It's 2%. 2%.
Whoa, I see what you're saying. It's 2%. Yeah, it kind of varies a little bit though.
No, it hasn't varied in the last few.
Well, that's because Trump tells them he wants 2%.
Yeah, that's the whole point, right? He says, "I want 2%." You're getting 2%.
I just think that it's the one kind of economic indicator that's actually just a result of other economic indicators, and they should nail it, and they should be able to tell you what it is. And it is a backward-looking indicator, and I contend it is basically useless.
Well, if you're trying to, if you're trying to you're trying to trade money off of it, it's useless. Yeah, I agree with that. So we were talking about J.P. Morgan number 3. And asking the question as to whether the breakout's for real. And, well, you know what? What I'm going to basically say is that it has done nothing wrong. It hasn't gone up since we mentioned it because that's the typical reaction. Once we bring it to everyone's attention, we goocher it somehow. Yeah. But overall, it's still actually consolidating above its 2019 highs. So I would still want to say that I don't want to write this off just yet.
Jury's out.
The jury's still out. I think. I mean, this could have one big update to 120 and then just blast off. So it's still the jury's out. So number 2, there has been nothing, but it's incredibly quiet.
Yeah. Well, not only has there been nothing, I believe there was some sort of ceasefire that they were talking about today, and which caused oil to fill the gap. Pull up the chart, Patrick. It filled the gap.
It's crazy.
Remember the Saudi gap? Remember the
Well, it's crazy that we go from what was that 20% gap or something like this, and we find ourselves a week or two later. Well, you know what was it? What we said when we were texting each other that weekend? It's like you're gonna fade this gap, and you're like, with that kind of move, 100%. You were like all over that, right?
Yeah. Well, I was surprised by the move.
It's funny. I I shorted that day. I put a very small position in, and I covered it like within 24 hours. Boy, do I regret that. I should have just held that and actually made some money. But fading that was interesting. But yeah, full gap fill. It's interesting. I mean, in theory, I mean, listen, this is all geopolitics now. Like, do you believe that things are quiet because there will be a strike? Like, you think that if they were going to do sanctions, if they were going to do threats, then they'd be beating their chest and there would be all sorts of stuff. But the thing is, you hear nothing. At least I haven't heard anything. Have you heard something? Is that not concerning?
I actually think that the geopolitical situation is precarious as it's been in a long time. So I contend nothing's changed, that it's not going to happen the next week. But we're going to wake up next month and something else is going to happen. So I still think the risks are more that something bad happens than something good. But anyways, that's me, and I might be too much of a pessimist when it comes to that.
Well, listen, I still think that attack has not been resolved, and the fact that it's really quiet, we're going to wake up one morning and there was some response, and it was, but it's a risk anyway. I'm not trying to say I have an insight on it, but I find it's just way too quiet, and that makes me highly suspicious. Anyway, S&P 500, the breakout never happened, right? We talked about these major highs, and it's been pulling back. And we're going to talk about some of the influences in our top 5 this week. So let's not get into an in-depth thing. But definitely the breakout on the upside did not happen. The S&P's been backfilling the previous rally. And things are really quiet, at least for now. But let's move on to the top 5 things to watch next week, Kev. And so what's number 5, Kev?
So we have the U.S. ISM manufacturing number.
Right.
So what do you think, Patrick?
Well, you know what? Cleanest shirt in a dirty. What is that analogy?
Really?
Oh no. Okay. Listen. What I'm getting at is, look, the U.S. Manufacturing has been under 50, but it's being dragged down because the rest of the world's manufacturing is below 50. Right? Like, you can't have a manufacturing expansion in the U.S. when the rest of the world is in a manufacturing recession.
Okay, so Patrick, it's actually, I just looked it up. This is the Chicago PMI, right? Is that the one we're talking about?
No, manufacturing.
Oh, sorry,
PMI.
there it is. The manufacturing PMI. It is supposed to come out on the 1st of October, and it's supposed to be 50.1 is the survey. I'm going to go out on a limb. I'm saying we're getting a sub 50 number.
Sub 50.
I think we're getting it.
I just can't imagine, with the U.S. dollar being as strong as it is, that somehow U.S. manufacturing would be flourishing in a period where global manufacturing PMIs are all, majority of them are, or many of them are well below 50. Yeah. It's just, the U.S. simply can't be isolated to that degree, and therefore I agree with you. It's going below. Okay. Bitcoin.
Oh.
All right, and so you know what?
So we got to say something, Patrick, because we were talking about this earlier. Pull up the chart, because I do not practice the dark art like
no, you do not.
I do not. But I must admit, I looked at this, and when I saw the formation, even I could see a descending triangle that kept bumping along the bottom. There's no such thing as a triple bottom. There it is in practice.
Okay.
Right? And I don't know why anyone, and do you know who actually tweeted that out? I think Peter Brandt, that technician.
Yeah.
He's a lot smarter. He's the guy who says there's lots of captains of the seas whose boats are at the bottom of the ocean who also didn't believe in charts. Great line. I really like it. But anyways, he was the one who said, I call it like I see it. It looks bearish to me. And I agree with them.
Yep.
And look at that, and we talked about that even before it broke. We said, I don't see what everyone else sees. It doesn't look bullish. It looks bearish.
I'll agree with that. I mean, I had a bias. I said I wanted to have confirmation of a break because I wasn't going to trade it to my thing. But to me, this is incredibly distributive price action. There is no sign of heavy accumulation or and for the fact that it's spent such a long time consolidating. If the bulls had momentum, then one of these breakouts would have stuck during the summer. The fact that we spent June, July, August, September, all just trading sideways down, lower lows, lower highs, lower highs, lower highs. That's just active distribution. I agree with Peter and I agree with you. That's not bullish price action. And if the bulls listen, maybe Bitcoin will become bullish, but the chart better start looking much better than that if they're gonna make a run on it, because that looks like shit.
Patrick, you had just said there's some terrible things that we're going to be labeled no coiners, and they're going to hate us. We're going to get lost.
I'm sorry. If the trend turns up, I'll call it the way it is. If it looks like Bitcoin is going to 20,000, I see no shame in saying it's going higher when the trend is very distinctly pointing that way. All we were identifying was that the price action did not correspond with everyone's opinions.
I will not do that, and I will contend that it's just on its way to fundamental value. I see it's trading about $82.25. We only have $8,200 more to go.
All right.
Just kidding.
You're not. You're not. Someone is going to Twitter shame you.
Yeah. Send all your hate mail to Patrick at bigpicturetrade.com.
Oh, no, don't even.
Number 3. Let's go. Fang. Okay, I chose this one. I'm going to talk about this because I actually think this is important.
All right.
And what I wanted to say was we have Fang, which has kind of led this market. And pull up all your charts here, Patrick. Let's get them up so everyone can see them.
Yeah. So let's
going to go through some of these names.
Let's go alphabetically in order. So
because
F is for Facebook.
Right.
So
I want to say what I'm looking for. I am looking. There are some that have rolled over. And we see these fangs, which have been the leaders that have rolled over. My question about what to watch next week is, do the ones that haven't rolled over join those ones that have already kind of given up the ghost? And that's what I'm watching for. So let's go through them and identify which ones have rolled over, which ones haven't. We're waiting for. Facebook.
Well, Facebook peaked out in June, July.
Looks like shit.
Wasn't able to in the August rally, didn't even do a 50% retrace of its prior sell-off, and has rolled over and is pretty much breaking to below its July lows. This is very negative price action. Right. Facebook is one of the ones in downtrend. So Amazon, the next one, looks exactly the same as Facebook. Peaked out in June, July. The rally was absolutely pathetic through August, rolled over and is already breaking its July, August lows. So the two charts actually are pretty rough. Now, Apple is holding up.
Right.
Apple
but it's truly not an original Fang, by the way. But anyways, we'll put it in there. It is holding up. It is one of the generals that are still sticking up there. Okay, let's go on. Netflix.
No, Google. Netflix and then Google. Okay, yes.
Yeah, Patrick's not good with the words, so we have to.
And I certainly don't know how to spell. And so
Netflix looks terrible. It's awful. It's a terrible looking.
That's been one of my great short sells. We nailed it at 330 with the members of Big Picture Trading, and we caught a good chunk of that move. But it's been one of the bearish ones. It certainly looks like shit. So I had a little bit of a support here. It's kind of 240, 250, so it could bounce. But it's been an awful chart, and it's going to take a lot of work to repair this chart technically to get bullish. But other than Apple, Google has been one of the good charts as well. I mean, it's not far from its 1,300 high from April.
It definitely has a trend that's up, and we can put in a little bit. Well, it's not really technically correct. The orthodox fangers won't be appreciate this, but let's put Microsoft in there because it's almost a fang.
Yeah,
it's also looking good. So
you know what? It is. What a technician will identify, I don't even need to have it on here, is there's going to be a divergence in momentum because even though it's holding up along the highs, it has stopped appreciating. And so, if you think about it, it's at the same price it was in June as it was in July, as it was in August. And often these can develop into topping formations as well. So it has done nothing wrong, but there's definitely divergences that would be very toppy here. which would be concerning for a potential trend reversal, which I'm not trying to forecast, but it is not.
So watch for that. Watch for Apple, Microsoft, and Google to roll over, because then they'll join the other ones, and it'll be bad news for tech.
Well, will that play into that whole different sector rotation and the different classes, like value versus momentum and all these different things? Like, are the FANGs going to get sold, but yet some value sectors and financials might rally in that period? I mean, is that possible, or
sure? That's what's happening, and that's what's going to continue to happen.
So what sectors do you think will continue to do well other than home builders? Because I know that's the first thing that's going to spew from your mouth.
Well, I think on a relative basis, financials will do well, and I think there'll be some other, value names like that, like of that kind of ilk. Who knows? Maybe even oil will do well in a real sell-off.
I'd like to. My wallet would like if oil was doing well.
Yeah.
But anyway.
Okay.
So
number 2, jobs
numbers. Are we finally going to see them uptick?
I don't know. I'll tell you.
They're lagging, right? So shit's going to already be hitting the fan by the time they start upticking. There's a lag there.
I don't know. I don't have a view. I agree with you that they are lagging. They're also volatile. Like, who knows? They can't get much better, though. That's one thing you think. Like, when you have unemployment at this low a number, just like, it's tough to make more jobs and stuff. So it feels to me like it only can disappoint. The real question is, if it does disappoint, like, do bonds go bid, or does the stock market just go offered? I'm not sure. Hopefully the curve steepens. That's all I hope. Okay, number 1. Let's go.
Here
we go.
Yeah.
So I'm gonna.
Kev,
this was my
you
choice,
take this.
Right?
Yeah, you take this.
Because I tweeted out today when news leaked from Bloomberg News that the Trump administration was looking at basically curtailing the Americans' investors' ability to invest in China. And I said that this trade war has now become a financial war. And I contend that the market is underappreciating what this means. I really do. I think up until now, we've been doing most of our stuff. Most of the kind of disputes between the two nations have been tariffs and of that nature. Now, all of a sudden, we have a situation where one nation is actually trying to use their financial clout to, influence the trade agreements. Now, some people said to me, it's always been a financial war. And yeah, I hear you. I understand that argument. But I contend that it is now an overt financial war. And I just don't see a situation where the Chinese go, hey, that's great. You know what? I think I'll come back to the bargaining table. No, what's going to happen is they're going to retaliate, and there's going to be something the other way. And I think that markets are just like sleeping at the wheel when it comes to this. I actually think this is one of the most negative developments we've had in a long time. I'm very concerned about this, and you know me, I am not one of these perma bears. For me to get bearish is actually a big deal. So I was already bearish going into this week. I'm only getting more bearish.
This just keeps fueling you. You're getting really passionate about this now.
Yeah.
I should take the other side. I have to start saying something bullish to create balance. Otherwise, we're going to lose all our bull listeners.
Well, the force will be out of kilter. I feel a disturbance in the force.
All right. Well,
what do you think? What do you think? Do you think it's like? Do you think I'm overreacting?
Well, you know what? Yes.
Okay.
Yes. But with that said, that doesn't make me believe. Like, I'm still bearish. Because I believe that the business cycle is very mature, and at some point the stock market starts discounting it way before a recession is officially here, and maybe we pop a little bit to a higher high on the S&P to kind of wash out traders that so don't make it easy, but I still think that there's the asymmetry is that there's going to be a much bigger downside risk than there is an upside potential. That makes me kind of design my portfolio that way. I want to play, obviously, some of that volatility that can really ensue in here, but I just don't know what. Well, maybe listen. Let's see how over the weekend all the different people pine in, and we'll see what influence it has on the market early in the week.
Patrick, that was a great technician's answer. If it goes higher, I'm going to buy it. If it goes lower, I'll sell it.
That's not what I said.
I know, but you waffled. You waffled. You waffled, buddy.
I just tried to take the other side. I don't know.
I know,
Fine.
but just say it's going higher, but you can't. It's like you have something.
I can't.
In your,
no,
there's
I
something
can't
in
say
your
it's
body. Like you're just like you tried to say, yeah, I think you're wrong. It's going higher, and
I
you were
couldn't
like,
say it. I
you
couldn't
almost
say it.
started it, and then you're like, no, I can't say that.
No,
I'm like, oh, yeah. So.
All right, Kev. Let's move on.
Anyways, I think it's a bigger deal than most people think. You know what? If we come back, a month from now and say, Kev, you were, a panic mechanic, you're welcome to say that. A month's time, tweet me back and say you were a panic mechanic. That wasn't that big a deal. It really was, the start of the Patrick's bull run. Okay, some parting wisdom. Shalin mentioned the trend is your friend. And I thought that this is a great line from Ed Sekoda. And he says, the trend is your friend, except at the end where it bends. He's a very wise man, that Ed.
Wise man.
Yeah.
Wise man, that Ed.
And Ed is not the guy in the Hangover movies, by the way.
No.
Different Ed.
He's not the one from My Tale either.
No, it's different Ed as well, yeah. But anyways, I do think that is wise because everyone says, just follow the trend, blah, blah, blah. It's easy until it's not, and then it gets really hard. And I'll contend that I think that the market trading this week was actually very choppy and difficult. I don't know how you found it, Patrick, but I found it prone to a lot of false kind of starts and stops.
I just can't believe that we're within such a range because normally we could be swinging 50 to 100 S&P points in a week's trend, and it seems like a ping pong match still, and it's like the bulls don't want to let go, and the bears don't have the tailwind to be able to kind of break that the technical back of the bulls, and so we're kind of sloshing around, but at some point, liquidity will matter, and it's going to drive a trend move. And it's going to be really interesting. I still think it'll be to the downside. I think it will.
Patrick, I'll tell you one last thing that I'll leave you with. On Wednesday, I think it was, I noticed that there was some buying, and in the stock market, and there was selling in the bond market and the gold market. I contend that this week we saw a massive unwind where someone was covering their short stock, long bond, long gold. And I really do believe that occurred all week, and that the stock market was kind of bid better than it should be, and gold was offered more than it should be. And I also believe it was related to the yen somehow, and I have no basis for any of this. People ask me how I guess this. I go, I don't know, just kind of spidey sense, and that's what I'm going with. But I really do believe that we're going to look
you think the yen is going to make a move? You think that U.S. dollar is going to...
I think yen's headed higher, a lot higher.
Really?
Yeah.
Now we're talking the U.S. dollar yen, right? We're going like 115 type of thing.
No. I think the yen's going up, so I think it's the other way around. I think we're gonna head back down in terms of U.S. JPY. I think we're gonna.
Well, I'll sold to you, buddy. I'll take the other side of that deal. You want to meet in the machine?
Yeah. So you think we're headed to like?
I think the U.S. dollar. I think the U.S. dollar is gonna move. Yeah.
Okay, we got ourselves a trade. It's 108 right now. Let's take two handles either way, each side. So we'll play. It's 107.88. So I got to do this fair. So we're gonna say 109.88 versus 105.88. One touch.
Okay.
And let's do burgers. You're on.
All right. Let's and then what we should do next week's show is we can update everyone on our bets to see where
I'm going to put it in the Bloomberg right now.
All right. Well, big shout out to Shalin for a great interview, and everyone can stick around to hear more from him in the after hour interview. And otherwise, First of all, also, what I'm shocked with how many people listen to this as a podcast over the YouTube, which is fine, which is great, but a lot of people don't get the opportunity to see the slides. You can go to the markethuddle.com, and you can register, and in your inbox, we don't spam you or do anything. You can get the weekly email. It includes the chart decks, so you can see what our guests are showing us on those charts, and the links to the different things. So if you wanted to actually watch the the video, the WTF video. You can quickly catch up on it. So make sure you register. It's cool if you're listening to the podcast, but register for the email, and that way you can catch up on those things you missed visually, right?
Right, and also we forgot to give a big shout out to Kuppy.
All right. That Kuppy's Corner was awesome. You know what? Yeah. I really enjoyed doing that quick interview. Those are listeners that don't know. Kev couldn't make it at the time, so I had to do the interview myself. A nice change from the...
When I dominate and hog all the conversation.
Yeah, you're such a hog.
Exactly.
Unbelievable. And so, but anyway, I'm looking forward to getting Kuppy off the air. He was quite bearish. He didn't say it in the interview, but he was quite concerned and felt like doing some selling. So not on his favorite stocks, but certainly on his broader equity holdings. But it was pretty good. Anyway, anything else? Yeah, you could follow Kevin. Kevin, where can they follow you on Twitter?
Kevin Muir, and you can check me out at themacrotourist.com. And Patrick, where can they find you?
Yeah, you can follow me at Patrick Ceresna, and you can also follow me on the website bigpicturetrading.com.
Okay.
Right, and otherwise, thanks everyone for joining us. It was a great time, and let's get into the after hours, eh, Kev? All right, so here we are in the after hours show, and Shalin, you're back online here, and well, first of all, thanks for a great interview. Now, you're out in Florida right now, are you not? Is that where your office is located?
Yes, yeah, in the Fort Lauderdale area.
Nice. How's the weather out there? I'm going to be actually heading there. I got a little show in Orlando in a couple of weeks, and things sunny out there?
Oh yeah, nice and hot.
Okay, well, we have to ask you the question. I saw on your Twitter that you had a great story of when you came to Canada to visit. Now, were you visiting Kieran? Was that right?
Actually, believe it or not, I'm almost all of my family is located in Canada.
Oh wow! Okay. You were the smart. You were the smart one that chose Florida. That chose Florida.
I don't know. Sometimes I question that. But yeah, I've pretty much. Most of my family's in Calgary.
Okay.
And I've got some small. I've got a cousin in Toronto as well. Right. But I spent almost every summer in Calgary growing up.
Okay.
So because my parents are just basically they couldn't handle me, so they would just dump me in Canada.
People don't.
So I pretty much know.
Yeah.
What?
People don't realize that Calgary, it actually snows in the summer, and we're not kidding about that. And you were there. I'm sure you experienced it.
Yeah. Oh yeah, I've been in the winter too, by the way. So yeah. I mean, I know minus 40.
Still, by the way, it's a beautiful city.
It is.
I absolutely love it.
Yeah.
But yes.
But anyways, you had a great story. You got to tell the story because I saw it on Twitter. You ended up hitchhiking, or I don't know. You got to give me the whole story because it was a great story, and I'm sure our listeners would love to hear it.
It was totally crazy. So yeah, here I am. Okay, so I go to Canada as I do every year practically, and see my family. And they're gonna have a party. So we usually have like a kind of a cowboy barbecue party at their house. My cousin has a phenomenal house, and our friend Kieran is he's actually located in Idaho.
Right.
And so I said, this is probably the closest I'm going to be to you. We're about 7 hours apart. So, we ought to meet. I said, okay, yeah, that's great. And so, we pick a place like in the middle of BC to meet. And so, I do the usual, right? I rent a car and I'm driving the car, and anybody who's driven in Alberta knows the moment you get out of Calgary, there's pretty much there's nothing there. And basically, about 120 kilometers in of a 240 kilometer drive, my car starts shaking. I'm like, this is really weird, man. And then, basically 3 minutes later, it starts slowing down, and I go to the shoulder of the road, and I'm like, oh my God. It's about 9:30 in the morning. Supposed to meet him like at 11:30 for lunch.
Where were you meeting, by the way?
And
Where in BC?
Fernie.
Fernie. Okay, fair enough. Good skiing town. Okay, continue.
Yeah.
Yep.
So anybody who knows Calgary to Fernie, that's like a 4-hour drive. Okay. And
not for Calgarians.
and
they do it a little faster than that. But anyways, okay.
So yeah, my car breaks down, and I don't know where it was. The whole story's on Twitter. I have a lot of screenshots, but basically, I have to make the audible. Right, I have no phone service. I'm madly texting Kieran, like, can we cancel? And it's not going to him because I have no phone service. Literally in the middle of nowhere. Basically, 30 minutes into it, I make the audible. I can't get a hold of anybody. I don't know what to do. Practically, I'm sweating. And I leave the keys in the car. I put the emergency lights on, the flashers on, and I just basically, I stick my thumb out, man. And believe it or not, like the first person who, kind of saw me was, basically, picked me up. Says, where are you going? I said, man, I need to get to Fernie. And he's like, well, I'm not going to Fernie, but I'm going to Crow's Nest Pass, and I can drop you off there. And that was about a 60-kilometer sort of drive. And so I said, okay, fine. I'm just getting me to my direction, and we'll go. And it was great. But then I'm in Crow's Nest Pass, and I'm still about 45 minutes or so out of Fernie, and I have to figure out how to get to Fernie. So I'm at a gas station, and I just basically start going up to everybody. Hey, are you going to Fernie? Are you going to Fernie? And people are looking at me really weird, who is this guy? Yeah. But you know what? Like the third guy who I spoke to said, I'm going to Fernie. Happy to take you. And super nice guy, great conversation. Dropped me off right in the middle of Fernie. And I actually made my meeting and my lunch meeting, and I got to finally meet our friend, in the flesh. But there was a problem, guys.
What's that?
How do I get home? So at least at this point, I have cell service, and I basically text my cousin. I said, what do I do? And so they're calling around trying to figure it out. I'm like, I'll even fly if I have to, but there's no airport or anything like that. Yeah. So I ultimately end up taking a taxi. It was by far the most expensive taxi ride I've ever taken. But
should have used Uber.
And I should have. There's no Uber in Fernie, believe it or not.
How much was the cab ride?
It was $602.
What?
Yeah, but that's
Canadian dollars. That's nothing
like,
for you.
It's like
that's Canadian dollars.
It's like $132 or something like that.
142 American dollars or something like that. But yeah, and this guy was like totally happy.
Yeah.
But it was a trip. It was a trip, guys, because I'm sitting in the front seat with the taxi driver, and he's telling me his whole life story and about how Fred's a horrible coworker. Like, I don't know who that Fred is. It's like, but you just have to kind of nod and
yeah.
But he was super happy, but the beautiful part about it was that I put in a claim with the car rental company and actually got a reimbursement. So the whole thing was taken care of.
There we go. That's a great story. The only part that I'm going to quibble about is the fact that you said between Calgary and Fernie was in the middle of nowhere. As a Canadian, I can attest that that's actually pretty populated for out west. That is not the middle of nowhere. Like I thought, like when I saw it, I was like, "Oh God, he's going to be way up north." Like, hey, like he could be north of Edmonton and like near Grand Prairie or something. And then like you're telling me you're at Fernie, and like this is the middle of nowhere. So that's my only quibble about the story, but otherwise it's a great story. Okay, let's talk some markets. Let's talk some markets. You spoke a little bit about the bond market. You talked about the stock market. Why don't you talk about, we were talking a little bit before we did the show about how you use different ETFs. And one of the things that you view as a strategic advantage is that you're open to using different ETFs in different ways. Why don't you give us some examples of the different kind of products and that you might put in in your portfolios versus a more traditional manager?
Yeah, sure. Well, the kind of the conundrum that we've been trying to figure out is how most tactical models, as you guys know, will try to use fixed income exposure as some form of a risk management asset class, right? So basically, I'm not too thrilled about equity risk. Let me just throw it into some bonds. Problem is that bonds are very risky. If even if yields are going to go lower, the path is not going to be straight, and they're extremely volatile now because the duration of some of these instruments is just significantly more than in the past. Right. And so and in some cases, when you're at the zero bound, like why would you buy a German Bund?
Because it's going to go more negative, don't you know?
Yeah,
Yeah,
it's the convexity.
Exactly. But that makes that as an allocator, that makes no sense to me whatsoever. So that's where we're on the same page. That being said, if I were concerned about equity risk in general, are there surrogate trades that could be created that kind of act like bonds but are not bonds? So they have much better what we call convexity, and so there are some interesting products out there. For instance, one of the products that we find pretty interesting is the anti-beta ETF.
What's the symbol for that? I don't know that.
BTAL.
BTAL.
Giving them a free plug.
Free plug. So it's anti-beta. Why don't you tell us about it? What does it do?
Yeah, basically this is an ETF that will buy a basket of the lowest beta stocks and short a basket of the highest beta stocks, simplistically. And the whole kind of thing about that is in a market event, in a market dislocation event, the low beta stocks should outperform the high beta stocks, right? You have an equal amount of each on the long and the short side.
Until the correlation of all assets becomes one. Anyway, sorry.
It's a good point. It's a good point. So the correlation could be one, but the beta could be different, right? So because the volatility profiles of the assets are different. So what you should still end up getting, you probably will lose on both sides of the both sides of the books will decline, but one will decline more than the other. And so what you find with that product, and we also complement that with some S&P sectors. Like the industrials versus staples, for instance, what you find is that they do appreciate just like bonds would, and you can just go onto a Bloomberg or overlay a chart, fixed income, and it looks very, very similar. Now, likewise, you're probably also going to lose money if fixed income yields rise, right? Because that should benefit more cyclical or higher beta sectors. But what you also find, and this is also, Kevin, probably music to your ears, but what you also find is that the downside properties of this trade are significantly better than just a straight fixed income trade. So if you're kind of trying to produce a palatable return to investors, because investors don't want volatility, we all know that.
Right.
This is one way of doing it. And so we're always kind of constantly figuring out, ways to adapt to this environment, which is just changing very, very rapidly and is meaningfully different because of what's going on in bonds in general.
So do you think that I'm intrigued by that trade, because one of the things I worry about is that this kind of 2-decade long negative correlation between stocks and bonds is going to break down. And maybe I'm wrong. Maybe it's 3 decades. And if it does, I worry that a lot of people are going to get hurt. Like I actually think that's one of the potentials for the biggest problems going forward. So are you worried about that same thing? And if so, would you argue that this is a better complement to stocks than bonds? Like, is that what you're kind of in essence saying?
Well, in our context, it's a way of taking advantage of a risk off, where bonds are no longer providing the same sort of returns mathematically as they might have in the past. So that's the first thing. And then the second thing is, because bonds are not necessarily providing the same sort of upside in the past, it naturally means that the downside, upside sort of ratio is much different now, and obviously much favored, to the downside.
Isn't that just a
And
quant's
so,
way of saying yes?
so the answer is yes, but there's also something else I think that investors should and macro guys should probably take heed of. That, to your point, actually, one of the things that we've done as well, so we're constantly tweaking our models based on kind of our view of the world, is we think volatility trading is probably going to have a new life to it, long volatility trading. So if in the world that you're describing, which I also, that's what keeps me up at night as well, trading volatility on the long side is probably going to be an attribute that's very important to portfolios, because that also can act as a surrogate to the sort of losses, the lost return that fixed income could generate, for you in the past. You didn't need to be long volatility in 2008 because TLT would rally 20% in a matter of weeks. It could happen again with TLT, perhaps. But the lower bond yields go, unlikely, and it certainly won't happen again with German bunds.
Right.
Oh my God! Well, yeah, until they're minus 1.5, and then when they're minus 2.
Yeah.
I mean, listen, if U.S. rates can go minus 4, I mean, we can go much further in Germany, right?
Yeah.
Yeah.
But how do you do? So I personally, when I want to get long vol, I just end up buying a bunch of options and delta hedging it. What do you do to get long vol in instruments that, like, I don't love buying equity vol. I'd rather own fixed income or FX vol. So how do you kind of implement that trade?
So, because we run a diversified portfolio, we do a little bit less in the option space, and we're generally trading Delta One. So for us to go long vol, we'll trade the VIX futures.
Okay.
And so that allows us to kind of figure out how we want to be positioned in the curve. Do we want to be a little bit more longer dated or shorter dated? That's based on the models and the view. As far as fixed income vol, we trade. So again, we have a whole menu of fixed income and credit ETFs that we'll trade based on the regime. So if we thought, for instance, that rates would rise, we might want to park our assets a little bit more in floating rate debt. And so we just like that sort of exposure because we're not options experts. We will, trade options here and there, but it's never going to be a large, part of our P&L.
Okay. So I also see in your kind of slide that you mentioned, like, you even trade bank loans and what is this, business development companies? What is that? I don't even know what that part of the credit is. How do you trade? Is there an ETF for that?
Yeah, there is. Or you could just buy a basket of them as well.
So what's
a business development company?
Or no, I know, what's the business development ETF?
We trade the BDCS and the BDCL.
Okay, let me just look at these.
So the BDCL is a leveraged BDC ETN, but it's not leveraged in the same way that we think about some of the more traditional ETFs. This leverage factor is actually reset on a monthly basis.
Okay.
So what happens is that you don't get the same decay. You don't get actually any decay. The sort of decay that you see in the daily products like the VIX, which is which obviously very detrimental to anybody who wants to be long. So the reason we find that very interesting is because, once again, here's how we would create an algorithm. For instance, if this kind of comes from the fact that I used to invest a lot in the CLO market, and what I realized was that, hey, wait a second, it's really a lot of things are the same risk. So if you're buying a CLO, which is a pool of loans, effectively, just generically speaking, it's really not terribly dissimilar at the face of it than a BDC, which is also a pool of loans. And so if you had a really good model to trade CLOs on a macro basis or loans on a macro basis, because you said, okay, well, GDP is this, or leverage is this, you have all these different factors, you should be able to transplant those same factors for BDCs because it's a pool of loans. Right? So if you have 1,000 pool of loans on your left hand and 1,000 pool loans on your right hand, Statistics, from a probability standpoint, the same factors should drive them. And so what we like about BDCs is the extra juice that we can get because if they're yielding 3 or 4% more than a traditional loan in that wrapper. And what happens as well, as you guys know, with BDCs and a lot of these instruments, is they can get dislocated. So they could be trading significantly below their net asset value, and it creates tremendous opportunities.
Right. Speaking of kind of things getting dislocated, you mentioned early in the first part of the interview that you thought private assets were in a bubble. Why don't you tell us a little bit about what you're seeing there and what your thoughts are?
Well, I mean, you guys heard of this company called WeWork? So, I mean, so part of my background is, in addition to, trading this quant book, when I ran a family office, I did a lot of private investing, and I would underwrite deals, and so in 2010 and 11, and we were just shooting fish in a barrel, man. I mean, I could easily underwrite a deal for 20% with a high confidence level, and I did a number of those deals. But what started happening was 2014. I started getting deal flow, and I'm having to lower my threshold, right, to 13 or 14%. I'll still do it, right? But 13 or 14% is not 20%. Well, then I'm in 2017, and now it's like 8%. So literally, I'm taking a set of scenarios, exact same set of scenarios I'm doing before, and I'm underwriting deals for 8%. And in some cases, my base case was in the low single digits. And if you start thinking about it from an allocator standpoint, so if you have to pay fees, say you're paying 2 and 20 to a private equity manager, your whole return is eroded. And for me, that was like, the ding, ding, ding moment where I realized that, hey, wait a second, this is really just equity risk now. It could be even worse than equity risk because it's illiquid. And you're probably better off being more tactical in the equity market, waiting for that dislocation, as opposed to kind of playing a buy and hold in private equity. So that was kind of the aha moment. And then, the other catalyst for me, probably the aha moment, was when I was offered Uber at $65 billion in 2016. And at 30 times sales or something like that, at least. It might have been more. And every family office, every investor was clamoring for that deal. And, just having seen this before, I said, this has to be it. And so what I think we're seeing right now, frankly, is the 2000 and 2001 moment. The problem is, and this is what makes it really crazy, is that a lot of it is still illiquid. Like, at least in 99, we all saw ourselves lose money, right? Right in front of us. That was, it sucked, but, but we lost money. Yeah. We could see it. Now it's like, you don't even know what your mark is, right? You don't even know that you're down 80% potentially.
Right.
And so people just kind of go on with their lives, I guess. And I don't know if it's good or bad, but there's a lot of losses out there, which I don't think a lot of people realize.
But I guess, though, the thing about 2000 that was different, it was spread over into retail, and this will be different in that it's in the hands of family offices, high net worth individuals, pension funds. Like, it really isn't is kind of spread throughout the economy.
Well, it's probably in a way it's sad. I think that the retail is no longer involved. I think a retail customer has bigger worries on their mind these days than the markets, which is just a sad testimony.
It's sad that they didn't make money on the way up, but I don't think anyone's going to be sad that they didn't lose on the way down.
No,
right?
No, I mean, look, the somebody's going to lose, right? It might be spread across a lot of different people, or it could be, instead of the retail investor owning it, it might be in their pension fund.
Yeah,
well, that's true. Yeah.
So, right, so maybe it not being concentrated in the hands of a few could be a good thing. But from a macro standpoint, when you have this much money that's been chasing these deals at such ridiculous valuations, there will be losses for the overall economy. In fact, mathematically, they'll be worse than the previous cycle.
Right. As a percentage, or just in absolute dollar terms?
From an absolute dollar term.
Yeah, just because the economy's bigger.
Right.
Right. So you mentioned, you said that you think that people don't realize the losses that their portfolios are have experienced already because nobody's marking it. So does a kind of shock where, that moment when Goldman Sachs and Bear Stearns and everybody remarked their CDX exposure and there was kind of an awakening in the markets, does that happen on the private side and does it kind of spread out into the public markets, you think?
In a weird way, the public markets are almost a safe haven because only, and this is where I do grapple with this as well, because only the highest quality companies have been able to go on to the public market. So all the crap is in the private markets, and there's been a huge hurdle to be in the public markets. Likewise, one of the things that we realized, some work that we had done a couple of years ago, was that across a swath of assets. And there's some guys on Twitter, for instance, have talked about this as well. You actually had better valuations in public assets than you had in private assets, which is weird, right?
Yeah.
And so, I think that it's just basically probably going to be a lot different, which is more of an L shape, kind of a deflation, if you will, of just people are just going to start realizing they're not getting any distributions. And so therefore they can't commit any more capital to these deals. The 08 it's very unlikely that the 08 sort of scenario is at play here because everybody's optimized their the way that they do things for that sort of environment. But I think we're really just stuck in an environment of really low crappy returns, which is could be frankly even worse because at least within 08 just got done over with.
Right. Well, it was a pleasure having you on, chatting on that kind of cheery note. We'll leave it. It's probably actually, though, it's a very fitting note given the difficulty in the market these days. Thank you very much for being on. Why don't you tell people again where they can find you and kind of give people your coordinates?
Sure. Bodhitree CIO, BODHI TREE CIO. Website, btam.co, and happy to, you can email me from there. And I really appreciate you guys having me on.
Oh, thank you for being on. It's great to have you, and have yourself a great time out there.
Yeah, and make sure your car doesn't break down in the middle of nowhere, Canada again.
You know what? This sort of experience where I'm going to be able to tell my my grandkids about that. It was phenomenal. And by the way, just as an aside, it gave me a real. It's one of those things where you get a real insight into Canadians, and you guys are the best.
Well, it's too kind. They were actually just looking for some beers from you. That's the truth of the matter. Anyway, thanks for being on. It was a pleasure having you.
Thank you.
Have a good one. Bye-bye.
Okay, Lena, hop on. Hello. Okay, super session number 7. Let's start with the important stuff here. Super session. It actually sounds like a blend of like a marijuana strain. Doesn't it?
You'd know, wouldn't you?
No. Not me.
I mean,
it says
super. It does kind of.
It says at the top, "Keep cold."
It does look like it. I agree.
That's like the drawing of like hops.
Yeah.
Kind of like.
And it's like green and stuff. Like it could be like a marijuana thing. Yeah. Okay, so let's do it. Let's review this bad boy.
You want me to go first?
Sure, do it. Shoot, Patrick.
All right, so normally I usually keep it from like 5 to 10 for that, 5 being bad and 10 being good. It's a 4. No, just kidding.
Really?
No. It's I would give it, let's say, a 5.7. It's I would not buy this again. It's I apologize to Lawson's, but you know what? This is just not my style of beer.
Yeah, we need to be honest. Even though they're our sponsor, we have to be honest. We can't, our listeners won't appreciate it if we don't tell it how it is.
Yeah, no,
exactly. Maybe Lawson's could send us another.
How many
one
sours have I rated? How many sours have I rated higher than this?
Too many, because there's nothing that deserves to be higher than that. Like a sour, no sour is higher than this. Lena, what did you think?
Well, like you said earlier, it's interesting, and it's a 12-ounce can, and I only drank 1/3 of it.
Oh my God, this is not going well. Okay,
It's
so
a little,
what's your
a little
rating?
too hoppy for me.
Yeah.
And it's kind of like it bites you in the cheeks a little bit. You know, it's so hoppy. I would give it.
And you would think that would have a higher percentage than 4.8% alcohol. If it's gonna bite you like that, you might as well be getting hammered at an 8% IPA, right?
Yeah.
I don't know.
Like this is a 4.8.
I hate stuff that you can taste the alcohol, so I don't care about that. But like I agree, it bites you in the cheek. What's your rating there, Lena?
I hate to say it, but I'm gonna give it. I'm not even gonna give it a number. But I'm gonna say it's gonna be below 5 for me.
Come on, you have to give it a number.
4.6.
Own it. Oh, there we go. Own it. I think you guys are too harsh on this thing. I'm giving it a 5.9.
like that's so much more than my 5.7. Jesus Christ!
I think it's a very acquired taste for this beer. It's kind of
it's
like
just too hoppy. I agree. It's like
it's
really
kind of like when
hoppy,
people. Some people love cilantro and some people hate cilantro. I love cilantro, but some people hate it. So it's kind of like the.
Some
same
people
thing.
say it tastes like soap.
Cilantro? No.
Yeah, isn't that it? Yeah.
Doesn't taste
It's
like
like
soap.
if you.
Lavender
No, that's
tastes
what-
like soap.
No, if you have some gene that makes you taste cilantro like soap. Now I'm gonna Google this while we're talking. Tastes like soap.
Do you like cilantro?
I love
Yes, I do.
cilantro.
Yeah, me
Oh
too.
my God.
Yeah. Yeah. So here it is.
Love.
Okay, so we all have the same genetic background because let me read you this. Okay, here. Oh wait, this pop-up came. But for those cilantro haters for whom the plant tastes like soap, the issue is genetic. These people have a variation in a group of olfactory receptor genes that allows them to strongly perceive the soapy flavored aldehydes in cilantro leaves. This genetic quirk is usually only found in a small percent of the population, though it varies geographically. Interestingly, places where cilantro is especially popular, such as Central America and India, have fewer people with these genes, which makes explain blah 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 blah. So there you go.
Right.
So
Wow,
we do not have that. We're okay.
Great.
We're okay. I'm glad. And you know what? For the longest time, I would like go to a burrito place or something, and they'd ask you want cilantro, and I would say no. And then one time I had like some chimichurri or some kind of like really thinking it's like, oh my God, this is so good. And like and then ever since I've been hooked. Like I put it on everything. I love that stuff. Anyway,
He's
I'm
a
drunk, by the
cilantro
way.
addict. A cilantro addict. He's a cilantro addict. He's got a problem.
But I need to ask about this.
He's buying bushels of it. Bushels of it. The local supermarket has had an intervention.
But let's talk about that karaoke situation. I need to.
Oh
I
my
need to.
God.
I need to probe more about this karaoke situation you had at the wedding.
Oh my God, that was brutal.
First of all, you were saying, revenge.
Okay, so he was marrying a Vietnamese girl. So like, I guess in that culture, that's like it's a tradition to have a karaoke machine. I guess like I don't go to too many weddings, and I've been very few that have had a karaoke machine. Is like that kind of completely blindsided me. I didn't think in a million years. That was like one of these things that it happened so fast. I didn't even know what was going on, right?
You know who else was blindsided? His wife. She probably didn't want you singing at her wedding.
Oh no! That I heard about that for a while afterwards. Yeah, it was brutal.
So.
Oh well. Anyways, I think it's bullshit though that you didn't know the words.
Everybody knows the words, at least in the chorus, no?
Oh, the chorus, but I didn't know how to
come on.
sing the.
Let's be honest now. In what year is this, Patrick?
I don't know.
Like
it was like
2000?
it was 2001 or something like
Okay,
that.
I'm gonna
yeah.
Google Shania Twain in 2001 and tell me you didn't know like her, and you know.
She was so big then.
Oh no! I knew who she was, but I forget it.
You
I'm
were
not even.
singing. You
I
were
am,
singing
yes,
in your. In
I
your,
w-
in
oh
your
yeah, in the
Hummer.
shower and everything.
Was anybody recording this situation as it was unfolding?
No, and it's thank God that back then iPhones didn't exist where everyone had a camera. Back then you had to actually have like a camcorder or whatever to be able to record shit. Like, that would be like all over social media in no time.
You may even have to explain what a camcorder is. Some people may not even know what that is anymore.
It's what we used before iPhones existed, right?
Yeah. Well, yeah, anyways, the Shania Twain, a good Canadian girl. You know where she's from? I think she's from Timmins.
Yeah.
Timmins, Ontario, yeah.
She's also vegan.
Really?
What?
Yeah. As far as I know, she's definitely vegetarian, if not vegan, for sure.
I don't understand vegans. That's a level of commitment I'm just not even...
Oh, yeah.
You know what? I envy them for having such discipline to not eat delicious things.
Yeah. Well, I go back 1 second. You know, this is not just vegan, but vegetarians too. If pigs are so smart, why are they so bloody tasty?
I agree. But I'll tell you, like, I could probably get away with being a vegetarian because, like, as long as I could eat cheese and eggs.
You can't have eggs when you're a vegetarian.
Well, you can theoretically. Like, you're not eating flesh. Like, I'm talking about giving up, like, eating, like, chicken and pork and beef and stuff like that. I could probably get away with it if I can eat cheeses and eggs and other stuff like that. But like vegans are pretty hardcore. Like some of them won't eat bread because it has egg and other stuff. Like I can't imagine giving up bread and pasta and all this stuff. Like
all the delicious
you're gonna eat lentils. That's all you're gonna eat.
Lentils and cilantro.
And water. Yeah, lentils, water, and cilantro. I was a vegetarian for a little bit, like in my weird kind of stage, and all I did was gain lots of weight as I had nothing but pasta and bread, Patrick.
Oh, when you're a vegetarian?
Yeah.
Yeah, it's really easy to carb load when you're a vegetarian.
For sure. And you go out for dinner and you're like, okay, I'm a vegetarian, and all you do is end up eating like, you know,
because you don't want to just eat a salad. So.
Yeah. So now I am a huge carnivore. I went out for dinner the other night, and I had we had the choice of dinner, and it was venison. So I described it as I'll have Bambi, please. I thought it was a pretty funny joke.
Oh yeah. I'm sure your wife was laughing. You know?
No, it was actually like at a work dinner thing or whatever.
Oh yeah, so now you're throwing your.
Well, you know what's funny is that I was there, and the reality was that everybody ordered Bambi. There were a bunch of just carnivores around me, so they actually thought.
Were you at the Antler restaurant or whatever it's called?
No, but like one of those places where they like kill an animal and eat every piece of it. Like one of those, like they'll like we just killed like this
nose
weird
to tail or snout to tail or whatever they call
it. We're gonna cook every piece of this, something, antelope we just killed. Come on in and enjoy it.
How was the venison?
Oh, it's good. It's good. Actually, you know what I'm a huge fan of is bison.
Oh, bison.
Now I am a Winnipeg boy, so maybe that's what it is. But I love bison. A bison tenderloin is like the best cutout piece of meat out there.
I gotta go try it now.
Oh, you've never had bison?
No. I've had a lot of different, but I've eaten ostrich, but I have not.
I've had ostrich too. Like I've had ostrich. I've had puffins. But listen, I'm gonna tell you where you got to go get bison. The best bison tenderloin is at the Post Hotel in Lake Louise.
Oh.
Okay.
So if you're ever in Lake Louise, go to the Post Hotel and have the bison tenderloin. There you go.
All right.
Kev's tip for the
now
day.
I know. Now I know.
What about for
That's actually now. It's funny that we were talking. There was I remember seeing those in the menu even in Calgary. Like I was staying at the Hyatt there one time, and they had all sorts of like these exotic steaks. I guess that's what you do when you're out west there, right?
Yeah, bison's not exotic. What the hell, man?
Well, I'm used to going to places where it's like you have beef or chicken. So to me, anything that's not beef or chicken is exotic. Right?
I was somewhere the other day with my middle daughter, and there was an ostrich burger, and I wanted to order it, and she wouldn't let me. She's like, "No, you can't do it." And like she was like, "But she'll eat a cow, no problem." But like I was like, "How is an ostrich any better than a cow?" Yeah. I was like, they're both like human. Like, as long as they kill them humanely, I'm fine with it. Like, let's eat it. Let's try this ostrich. But she had nothing to do with it.
So you didn't have the ostrich burger?
No, she wouldn't let me.
Oh, I was gonna ask what it tasted like. I've never had ostrich.
Oh, I've had it though before.
Ostrich is good, actually.
Yeah, but it's not that much different. You know what I've never had that I want to have is kangaroo. Now I know that sounds terrible. It really does. It makes me sound like I'm like one of those rich guys that eats animals like that are endangered.
No, but I had kangaroo jerky.
So there you go.
Actually, there's this one place like whenever I go down to Florida, they have like it's a jerky store and they have like gator jerky and kangaroo jerky and all that stuff. So
kangaroos kangaroos in Australia are like a menace. Like they're everywhere and they're everywhere. It'd be like us eating like raccoons. Really, like honest to God, if someone told me I'd eat a raccoon, I'd be like, not a chance. You see what that shit that guy eats?
I wonder whether the Aussies are like that when it comes to kangaroo meat.
I don't know. I'm not sure. They can pine in and tell us if they like it, but I wouldn't eat a raccoon for all the like money in the world.
No, I wouldn't either.
Yeah.
I'll become a vegetarian instead.
Yeah.
I've eaten a squirrel.
What?
I thought you were gonna say I eaten a raccoon.
No.
You ate a squirrel. You actually did.
Yeah.
Where?
Oh, that's where exactly.
I was
at
moose
the cottage.
Hunting. I know. I was
Honest
moose
to God?
hunting.
You guys shot one.
And we were hunting grouse and one of the guys shot a squirrel and we're like, we now got to eat it. Like we're hunters. You don't go and just kill something for sport. And so we cooked it up.
Was
it
it good?
It was a little rubbery. It was like eating rabbit or something like that.
Kind of gamey.
Yeah. It was nothing to write home about, but we certainly tried it.
Did you barbecue? Like put it on a stick?
We didn't we did it on a stick, but we did it but we put it in the oven. No, it was in the oven.
Oh my God, you guys!
That squirrel in an oven? Oh my God. That's a terrible visual. Like hunting out in the wild and shooting a squirrel.
I know, that's what I thought. Over the fire, and he's like cooking this squirrel.
We brought it back and we did it in the oven.
We put a little cilantro on it, and it was fine.
Oh my God.
And you know what? All I could say was you told me you were moose hunting, and I figured that you guys shot like a squirrel with a .308. Like I was like, was there any of the squirrel left to like eat? Like that's all I could think to myself.
The popcorn squirrel.
Okay. Anyways, that's it. We'll leave it on that note.
All right.
Guys,
all right.
well,
listen. Have a great weekend, everyone, and we'll reconvene next week.
Yeah. Thanks again. Thanks, Lena.
Okay.
Take care.
Thanks,
we probably
Lena.
pissed off all of our vegetarian and vegan listeners.
Oh yeah.
We're really not that bad, folks. Take care.
Cheers.
Good weekend.
Bye-bye.